Today, I'm going to talk about why most new investors will lose money in the stock market. And by doing that, I'm going to tell you a story about something that has happened a few days ago to me. And if you like this video and think it's better value, there's better content than my usual content, then please drop one of these, as it does help out a lot for any new viewers. Right, so what's happened recently and how does this relate to the stock market? Well, for some of you that didn't know, I have a motorcycle. That's something that I do. That's how I commute. And I quite enjoy it, right? And to talk about this story, I'm going to talk about how I've injured myself on the motorcycle and how it relates. So I'm driving back from work, right? So it's standard day. It's a bit cold these days. It was probably about 1 or 2 degrees and it was dark. So visibility is quite low, right? So I'm going out, I'm on my motorcycle. I'm going at about 10 to 15 miles an hour and I'm going about, I'm in first or second gear, I can't quite remember, on a very small bike. It's a 125cc bike. It's probably pushing it to be in first gear still, so I probably need to put it into second. Regardless, I'm going around a roundabout, I check, obviously I look both ways, it's clear. I look to the right, clear, cool. There's no car that's already entered on the left-hand side, fine. Going through, constant speed, you don't want to be slowing down, you don't want to be hitting the front brake, because if you hit the front brake, your wheel locks up and you're going to fall over. You lose momentum as you're leaning, right? And you don't have enough speed, you're just going to tip and fall. So what happens is as I'm going around this roundabout, right, what's happening as I'm going steady, and suddenly there's this moment where I'm like, I'm going to crash. No, I wasn't driving badly. I wasn't going to aim at something else. I didn't target fixate on something in the road. The wheel slipped. So from in front of me, I remember just looking and seeing the wheel go like that. So I'm leaning around like this. And normally if you're leaning right and you're going a bit too much of a lean, you hit the throttle slightly and it straightens you up. Because you've got more speed, the power pulls you up, right? So as I'm going around here, I'm not leaning that much. Again, it's a roundabout. There's no need to be. I'm going around here, and then the front wheel slips, and it drops this way. I just fall completely over onto the ground. Now, you might go, okay, that's cool, but how does this relate to the stock market in any way, shape, or form? And what we're going to be talking about here is the risk and risk management in general. This is something that new investors lack. This is a mistake I've made myself, and I would argue continue to do so until this very day. So what risk was it? Was it my ability? Did I overestimate my ability going into the roundabout? Well, not really. It wasn't necessarily my fault there. I suppose if I had advanced foresight, I could have seen that there might have been a road surface hazard. But again, in this time of year, it's very difficult to know that. So it's worth saying that motorcycles are risky in general. But then you could also argue the stock market is risky in general as well. You could say, some people go, oh, the motorcycle's dangerous. You're gonna hurt yourself. And people will also say about the stock market's gambling. It's not good for you, you're going to lose all your money. Very similar context here as well, right? And this is why I really like this example, and it really moves together. So as I say, it's not nearly to do with my perceived ability. I didn't overestimate myself. I didn't go too fast around a bend, right? I didn't invest in stocks I didn't understand here. What's happened is I've bought a stock I've understood, but what's happened is the foundations of that stock has crumbled underneath me, right? So not necessarily, you can't always see this happening, right? It might be an unexpected profit warning, much like that road surface hazard I had on the roundabout, which was likely a patch of black ice or something very, very invisible. It might have just been cold tires, right? Because of that, I've then gotten myself injured. I've bruised both my knees, bruised my ego, and also hurt my ankle a little bit. So obviously I couldn't limp, but again, it's nothing major. It's a minor injury. Please don't worry about that. But it applies to the stock market as well, right? Now, so how do you mitigate that risk? Knowing that perhaps if your ability is still, you might say your ability is good, how do you mitigate that risk from happening, right? You could buy a good quality business. Okay, I could buy a nice motorcycle, one with more grip onto the road and good wheels. Okay, that helps. But again, what if that road surface hazard still occurs and the motorcycle tips over? Or, a good quality business turns into a bad quality business. You could probably see the signs of this. You could see deterioration. You've got to maintain it, keep in touch with the management of the company. But ultimately, if we know that something is going to happen, how do we defend against it? And that's where diversification comes into things. You might go, okay, what do you mean here? I get it, but how do you explain it on a motorcycle? You want to be wearing protective gear on a motorcycle because if you come off, you can injure yourself. It doesn't matter how fast you're going, the way you land, if the bike lands on top of you like it did on my ankle, it's going to hurt. And my bike's only 120 kilos. That's light for a bike. Because it's a little 125 Chinese bike, right? It's a very, very small bike. Any bigger bikes, that would wreck your ankle, especially these super bikes, these like 1,200cc bikes. They're heavy, trust me. So naturally, my injuries were in my legs and my ankles. You know why? Because I didn't have the protective gear for that region. Obviously, had a helmet. I had the jacket there behind me. I've now got leather jeans I didn't have at the time, and I had armored gloves. That part of my body was perfectly fine, but my legs and knees weren't. So what happened here is that, and again, it might be going, okay, well, I could protect myself. I could buy, and these investors in the stock market, right, they'll buy loads of these tech stocks. It's the equivalent of buying 3 different leather jackets. Can you wear them all at the same time? No. What value does it give you? Your hands are still exposed, your head is still exposed, the rest of your body is, right? So it's like going, okay, there's more than just diversification. It's diversification into meaningful assets, right? So if I'd have, spared my money and invested in leather pants and leather motorcycle boots, right, I would have been more prepared. Currently, if we look at my portfolio, for example, I only hold 2 stocks. They're both consumer-facing stocks and they're both retailers, right? That's not very good diversification, and this explains why my performance in the last 978 days is down about 54%. That explains a lot because I'm not adequately diversified. When I owned another stock, I bought something called Argo Blockchain, but that's again the equivalent of owning motorcycle gloves and, maybe a leather jacket, and that's it. What's happened here is I bought a company that is in a slightly different industry, heavily risky and a mistake. Let's not go into that, which we've spoken a lot about before. But that didn't protect me. That's not diversification. Now, you might argue, okay, then what is appropriate diversification? How do I, as an investor, protect myself? How do I become a smart motorcycle rider in that regard, where you always wear protective gear no matter what? Well, ultimately, I feel that you've got to manage your systematic risk. You've got to understand that it's inevitable that one holding will eventually not do very well and lead to volatility. Likewise, with a motorcycle, that it's very likely at one point in time you're going to fall off that motorcycle. You're either going to fall off the motorcycle or you already have. Same applies to stocks. There's going to be a period of volatility where it's going to drop 20 or 30%. You need to be prepared for that. What you want to do is mitigate this potential risk by reducing your overall exposure to these individual stocks. Now, typically, a lot of investors or a lot of those that don't want to spend the time stock picking, right? They have a good strategy. They buy index funds. They buy the global stock market or the S&P 500. And this is diversified into thousands of different companies, or 500 in the case of, obviously, the S&P 500. And this creates a very good form of diversification. It's probably the equivalent of going, I'm going to buy a car and not ride a motorcycle because a car has crumple zones. I'm more protected if I have an accident. And yeah, right, that's probably the equivalent. Your car here is probably the equivalent of owning an index fund. A motorcycle is more stock picking, right? You've got to take on more calculated risks. You've got to be aware that other people on the road aren't going to be paying too much attention to you, and you therefore need to be more alert. The same applies to stock picking. You need to be focused in on your holdings and understand that. But diversification is a reason why most new investors lose money. And diversification is also a factor. So it's like going, okay, if you own too many stocks and too many of the same industry, as I mentioned before, having 3 motorcycle helmets is not going to give you more protection in a crash, right? That's also an issue. So where is the balance between too little diversification and overexposed, too much systematic risk, and the point where you've got way too much holdings that you're actually not going to get very good performance at all, and you'd be better off buying an index fund? Where is that fair point or line? Now, I don't know if I truly have the answer for this. I personally feel that 2 holdings is ridiculously risky because at the moment in my portfolio, as you can see, I hold 49% in Boohoo. This was a higher percentage before. Bearing in mind, this is a stock that's dropped 66% in my portfolio, right? That's a high amount. And obviously that 50%, let's just round it up to 50% exposure to Boohoo means if they drop, let's say, 10% right now, I've just taken a serious chunk of the portfolio and lost another 5% in returns. The maths is going to start getting a bit complicated and very easy to muddle up, so I'm not going to go too much into that. But the point stands, if Boohoo goes bust, which I don't think they will do, I wouldn't be holding them if I thought that, then I stand to lose 48.8% of my portfolio, which is not good. That's not good at managing risk. I get it. In an earlier stage, when you're a newer investor, when you're able to take on more risk, typically as a younger investor, that you can have more flexibility. You can expose yourself more to these holdings, whereas in retirement, where you're looking to preserve that wealth, you've already built up the capital, you're not going to be taking on as excessive risk because you're not after a high growth return. You're after probably more of a consistent income that you can rely upon in retirement. So the balance is to be found. Myself, I'm holding 2 stocks at the moment. I'm holding a fairly significant cash position, at least relative to the overall size of the portfolio, and I'm likely going to start expanding out into 3 or 4 stocks. See, that's already twice as good protection as I've currently got. Again, it might not be enough, and I think really the boundary for me might be 6. I'm going to aim to hold 6 stocks, but I'm not going to be pushing myself into these new companies without adequate research. I'm not just going to buy them for the sake of diversification. I want to still understand these companies, make sure that they're in an area where I feel that I have an advantage over the common investor, and therefore conduct a good strategy. It's like the idea and the business premise, which I'll leave this video with. You want to hire slowly and fire fast. Thank you for watching. Have a fantastic day.